Before Wall Street, before crypto, before housing bubbles, before modern stock market crashes, there was a company that sold Britain a dream. In 1720, ordinary people, wealthy investors, politicians, and aristocrats all believed they had found a shortcut to unlimited wealth, not through land, not through gold, but through shares in a company most of them barely understood. The price kept rising, the crowd kept buying, and for a moment it looked like everyone could become rich. But behind the dream was something darker: government debt, political influence, financial manipulation, and a company selling a future it could never truly deliver. This was the South Sea Bubble, one of the first great financial manias in modern history. And the pattern it created still appears in every crisis today. But to understand why people believed the dream, we first need to understand Britain's biggest problem: debt. Before the bubble, Britain had a problem. War had made the state powerful, but it had also made the state deeply indebted. Empires are expensive. Ships cost money. Armies cost money. Wars cost money. And Britain needed a way to manage the debt that came with becoming a global power. The South Sea Company appeared as a solution. It was not just a normal company. It was tied to the government. It was connected to debt. It was surrounded by political privilege. In return for helping manage government debt, the company received special rights and the promise of future trade in the South Seas. To the government, it looked like relief. To investors, it looked like opportunity. To the public, it looked like the future. But the foundation was fragile from the beginning, because the value of the company depended less on real profits and more on belief. And once belief becomes more important than reality, a market stops being a market and becomes a mania. The South Sea Company did not just sell shares, it sold imagination. People imagined ships crossing oceans, gold flowing from distant colonies, trade routes opening across the world, a future where one investment could change a life. The problem was simple: the dream was much larger than the reality. The company's real trade prospects were far weaker than the story being sold to the public, but in a bubble, reality is not what drives the price. Expectation does. The more the price rose, the more people believed. The more people believed, the faster the price rose. And once prices rise fast enough, caution begins to look like stupidity. Then the dream spread from financial offices into the streets, coffee houses, and ordinary homes of London. Soon, the bubble became a social fever. People who had never studied finance began buying shares. Coffee houses filled with rumors. Pamphlets promised fortunes. New companies appeared with absurd promises. The market became a theater of greed. Some people invested because they believed in the company. Others invested because they believed someone else would buy from them at a higher price. That is the dangerous moment in every bubble. When people stop asking, "What is this actually worth?" and start asking, "Who will buy it from me for more?" At that point, the asset is no longer an investment. It becomes a game of timing. And in that game, ordinary people usually arrive last. But every bubble has one weakness. It needs belief to survive. Belief can rise quickly, but it can disappear even faster. When confidence began to break, the price could no longer support itself. People rushed to sell. The same crowd that had pushed the bubble upward now pulled it down. Fortunes vanished. Families were ruined. Political reputations collapsed. And suddenly everyone discovered the truth. The wealth had never been as real as it looked. It was built on leverage, rumor, influence, and belief. The South Sea Bubble revealed one of finance's oldest laws. When everyone believes they can get rich without risk, risk is already everywhere. But the most important part of this story is not that the bubble collapsed, it is that the pattern never disappeared. The South Sea Bubble happened more than 300 years ago, but the pattern still feels modern. A new opportunity appears. The story sounds revolutionary. Prices rise, the crowd enters. Skeptics are mocked. Insiders profit early. Ordinary people arrive late. Then confidence breaks, and the public pays the cost. We have seen the same pattern again and again. Stock market bubbles, housing bubbles, crypto manias, and global financial crises. The technology changes, the asset changes, the language changes. But the psychology rarely does. Greed, fear of missing out, trust in authority, and the belief that this time is different. So the South Sea Bubble was not just a mistake, it was a warning. The South Sea Bubble was not just a story about one company, it was a warning. A warning that empires can turn debt into dreams, that governments and markets can feed each other's illusions, that powerful insiders often position themselves before the crowd arrives, and that ordinary people often enter the game after the safest profits have already been taken. Every financial crisis begins with a story people want to believe, a story about easy wealth, a story about a new era, a story about risk disappearing. But risk never disappears, it only moves. And when the illusion breaks, someone is left holding the cost. The first great bubble did not disappear. It became a pattern, and every generation discovers it again, usually too late. If you want to understand how money, power, and empires really work, subscribe to Empire and Economy. Because history does not just explain the past, it explains the system we live in today. And sometimes the next financial crisis begins with a story that sounds too good to question.